As millions across the US start to ease off for the festive season, so is the central bank.
FOMC raised our policy interest rate by a half percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
Smaller interest rate rise with rather bigger significance.
Raising that benchmark interest rate by 0.5% instead of 3/4, as the Fed has done 4 times already this year, may look tiny. But the implications are huge. It means the Fed finally thinks it's got on top of this inflation crisis and can start to dial down its strategy for dealing with rampant price rises.
That's because core inflation is retreating. At an annual increase of 7.1% in November, it's still more than 3 times the Fed's target of around 2%, intended to keep the economy on an even keel. But inflation has risen at its slowest pace since December 2021, an early Christmas gift for President Biden.
This new report is the 5th month in a row where annual inflation has fallen in the United States. Inflation outside of food and energy, a key measure that economists use, also fell. Make no mistake, prices are still too high. We have a lot more work to do, but things are getting better, headed in the right direction.
Nevertheless, the Fed rate impacts just about any kind of credit, including mortgage rates. At an average of nearly 6.3% for a 30-year loan, US mortgages haven't been this high since 2008. But despite this festive cheer, some investors think that more rate rises are on the cards for next year, even if they're incremental. Owen, Fairclough, CGTN, Washington.